Good morning, traders. Chris Buss here with your morning look at markets for Wednesday, June 16th. Hope everybody's doing well. You're all buckled up for our big day with the FOMC. Let's look at futures and then dive right into it. Equities are flat. Gold and silver flat. Everything's flat on the board as far as tradable assets here in front of the meeting, and I expect this morning to be pretty quiet on the trading front as people just simply get in position for whatever Jay Powell might say. We've got oil inventories at 10:30. We've got the Atlanta Fed out with inflation expectations. That might be interesting to be aware of. I think that's at 10 o'clock. And then, of course, we've got housing starts as well. And then we've got the FOMC statement at 2, and then presser by Jay Powell at 2:30. And that'll last probably like an hour and 45 minutes, something like that. He usually wraps up around 3:45 when he does these things. So what I've done and what I want to do this morning is a little bit different. I do think this particular FOMC statement has maybe a little more importance than a normal one. So I want to go through the different scenarios and kind of lay out a roadmap for us for going out of the statement and the market reaction. So let's go through it. I want to start down here at the bottom. So there's going to be a statement at 2 o'clock. The algos are going to read that. And then, there's going to be a wild bar or two. And then there'll be a presser at 2:30. And that's where there's always the potential that Jay Powell slips up, makes a gaffe, lets something out of the bag that he didn't want to say. For instance, if he just keeps getting beat over the head about inflation ripping and what are you going to do about it, and then the drumbeat, the questions just keep going, and he starts to wilt and said, yeah, well, we have talked about it a little bit, and then you see the market go crazy on a mistake that he didn't mean to do. So there's going to be some initial volatility. Just remember, just a rule of thumb, that the first move is usually fake. You see, it rip, and then they pull the rug afterwards and all that stuff. So whatever happens right out of the gate, it's not a time to run out and change your whole portfolio because of the move right after the announcement and press conference, because it's going to take several days for it to filter out and we get a true direction of the market. So I think in any of these type of events, I think the risk is to the downside. Like I said yesterday, if everything goes perfect, he comes out and says, you know what, we're still focused on unemployment, and we're not going to touch our QE program, and everything is just the way we want it, and the market accepts that. We probably grind higher, etc., going forward. But if something comes out contrary to that, then I think you'll see a bigger move to the downside. And we've got quad witching on Friday, which kind of muddies the waters because there are other forces at work that may obscure what the real market move is by coming out of the Fed. So then we've got, today's a lost day. We're just going to get that, and then there's going to be all this volatility. And then tomorrow it'll probably settle out a little bit. But then Friday, you got all these forces at work that want to pin the market at a certain place. So the most option traders lose. They don't let it run away. So all the call buyers make a lot of money, and they don't want it to race to the downside either, and then have all the put buyers make a lot of money. They want to keep it in a range. So then that leads us to figuring out really where the market is next week. So I think during this time frame, trade small, if at all. If you want to jump into that volatility and you're very nimble and that's what you do for a living, I'm not going to be one to say, don't give it a shot. If you know that's how you thrive, do it. See how you do. If you can go candle by candle and catch those reversal points and the whipsaw volatility doesn't bother you in the least, have at it. And I hope you make a lot of money. For the rest of us, especially swing traders and position traders, if you haven't made any of your adjustments to your portfolio as of the open at 9:30, just take a look at what you've got and just be very comfortable with how much risk you have put on in your portfolio. And you've run through the scenarios like if there's a 3% sell-off, Powell says something this afternoon and they pull the rug 3%, are you just absolutely fine with that? And if you are, because those are the names that you want to be in, then that's fine. If the prospect of that scares you, then you may want to take some off, especially if you're deep in the money on options or whatever you may be. It would be a shame to have, you have a lot of embedded gains that get taken away. So just, review your portfolios and make all those adjustments before 2 o'clock if you want to do that. Now, more importantly, what do we want to be watching for coming out of the Fed? We want to watch bond yields and TLT. Those are going to be real important drivers coming out of this meeting. I want to watch the US dollar. I want to watch oil and gold. And I want to watch the Fed balance sheet going forward. A rising balance sheet is supportive of higher asset prices. If the balance sheet goes flat or pulls back, taking with liquidity from the market, I think the market will have problems with that. For instance, if he drops a bombshell today, we're going to stop buying mortgage-backed securities, then you'll see a big red bar. But even if they don't announce anything and you see the balance sheet flatten out or go down, it's going to make it tough for the market. So let's look at some scenarios. And this is regardless of what he says. These are market-based responses. And so we've got to be focused on the charts, not what he said, but what is the market doing. Scenario 1. Yields stabilize where they're at or start falling. The US dollar stabilizes or is rising. In this type of environment, falling yields and a stable to rising dollar, that should be bullish the tech trade in general. The FATMAAN names, the names that have been perking up lately, the Facebooks, Apples, Microsoft, Google, Amazon, those should do well. The bubble stocks should continue to get a bid under them. These are the stocks that have big dreams but lose money every year or every quarter while they're building their business. ARK stocks, Cathie Wood stocks should do well in that kind of environment. The EV space, those high valuation names, and the solar complex should do well also. Now, what's the flip side of that? Bond yields rise combined with a falling US dollar. That should be bullish financials, industrials, materials, the commodity complex, cyclicals, and in general, the reopening trades. So those are the things that I'm going to key off of to make sure, or to lead us in the direction of where we want to be. Why? Well, there's no July Fed meeting. The next meeting after this will be Jackson Hole in 10 weeks, 8 weeks. So I think this kind of sets it up for the balance of the summer until we get to Jackson Hole. So, and there really wouldn't be very many other technical drivers that once one of these scenarios comes into play, that it would alter it. For instance, we had the big inflation print that, what was that, in the first part of April. That's what roiled the market to begin with. And then the print that we had in May was just as hot, even maybe a little bit more hot, and the market kind of shrugged it off. So the next time we get an inflation print, everybody's going to expect it's hot, right? And it's not going to have a huge effect because now everybody's planning on hot numbers. And if the market buys into it's all transitory, don't worry about it, by the time we get to fall, it's all going to be gone, then that's what it'll be, at least through the summer, at least through Jackson Hole. So I don't think any economic data coming out after this, based on what the FOMC says, is going to change very much. So I think it's going to be important to find out where we're at and then be in those sectors that look the most promising for the next 8 to 10 weeks. So let's dive into the charts here and kind of get a baseline of where we're at. This is the US dollar. We were in a downtrend, persistent downtrend. We bottomed out. We've got a prior low right over here. This is a slightly higher low, but we've bounced a little bit. And so now price is up against the declining 50 EMA. We've got some horizontal resistance at 90.75. Then we've got fib layers above. In order for the commodity trade to work, this has to reverse pretty soon. Why? Because once you take out the 50, and then once you take out 90.75, there's really not a lot stopping it till you get to 91.25. And then you've got a big overhead resistance level at 92. So if the dollar continues to rise, that's going to be bearish the commodity complex. That's going to be bearish most of the scenario 2 trades, financials, industrials, etc. What's next? TLT. What does this look like to you? Remember, when TLT is rising, rates are falling. So what have we got here? We had falling rates, false breakdown, more consolidation, and now this has been the 1 month trend off of the bottom of falling rates, rising TLT. We got the breakout above 140. We came up here just a couple of days ago, and now we've pulled back to the breakout, right? Breakout back touch. Going forward, we're at a pivot point at 140. Watch that like a hawk. Why? Because one, the trend for TLT is higher, meaning the trend for rates is lower. This is the scenario 1. Falling yields. Breakout, back touch, go. If yields continue to fall, that's what that's going to be. Breakout, back test, go. So 140 has to hold. What if it doesn't? Well, what do we always talk about when you get a breakout from a well-defined range, and then you break out, and then you fall back into the range? That's very bearish. That should hold. And if it doesn't, all these people know that they're wrong. And so then your target becomes the bottom of the box at 135. And then that would mean rates are rising. Here they're falling. TLT lower means rates are rising. So that's going to be a very important toggle point. And that will be a big tell on what's going on in the rates market and how the market interpreted whatever Jay Powell has to say. Here it is from the bond yield perspective. And you can see that coming out of last August, we had a nice uptrend line. We broke out. And now if I draw in this little channel here, I mean, to me, it looks a lot like a bull flag type action, or just some consolidation action, after a strong uncorrected run. So the key is this. The thick blue line here is placed at 150, 1.50 on the 10-year yield. There's a support layer at 1.4%, but then below 1.4%, there's a lot of room to come down into the 120s. And that would be dramatic. You would see a moonshot on TLT. You would probably see gold crater. What else? Well, it's gonna drive TLT. It's gonna drive TLT. So if we break out above 150 and start moving back up towards 160, 165, 175, that's probably going to be very, very bearish for tech, very bearish for bubble stocks, that kind of stuff, and would be very supportive of the cyclical trade. Financials would love that. Those kind of things. So watch the 10-year yield. Watch oil. Now, if you've been following along in the commodity complex, you know that there's been some significant corrective activity going on. They've pulled the rug on copper. Most of the base metals, aluminum, lead, tin, all that stuff, they're pulling the rug. and the grains have come back. The one thing that hasn't flinched is oil. We broke out and now we're running. I went back in the charts. This is the highest we've been since 2014. And that high was 76.90. Okay. RSI looks great. It's been in its bullish regime long time. Same thing for PPO momentum, and price is riding the 8-day with all the EMAs bullishly stacked. Now, does that mean it can't come back and tag the 20 or tag the 50? No. And if you got a pull back to the 50, I would be buying it. I would be buying it. That would be an example of some kind of knee-jerk move that would be scary to step into. But if you got some kind of knee-jerk whatever, and we get a couple days of selling, I would be buying it if it came back in here towards the 50. But let's look at oil a little bit more closely. In years past, when oil prices were rising, you would see a dramatic and quick supply response by the frackers. That's been their whole modus operandi. As soon as something happens, they're drilling holes in the ground and popping up all this extra supply. Not going to happen this time. Why? Because their access to capital is restricted. There's ESG restrictions that is choking off capital as well. Plus, we've got an administration that's making it difficult. Permitting is slowing down. More environmental regulations. They're taking swaths of national preserve land and taking it off the table for drilling. So I don't think we're going to get the domestic supply response that we have in the past. And if that's the case, OPEC's in total control of the marginal supply barrel. And I think they're going to be judicious. I don't think they're just going to open it up and knock $10, $15 off the price of oil. I think they're going to relish that position of being in control, and I think they're going to be smart about it. Oil is a global reopening demand trade. India is not even back yet. They're probably not even half back to what they were. So, and here in the U.S., we're entering peak driving season. I was out on the roads on Memorial Day. It was a madhouse out on the Florida turnpikes. I was out last weekend, wall to wall on the turnpikes. Nothing really going on, but people are out and about. And I think this summer there's going to be a lot of driving. I think there's going to be more and more air travel. I think on the industrial side, as things ramp, you're going to get a big demand, spike into the summer. And I don't think there's going to be the supply. I think any dips should be bought, and I think it's going higher. And like I said, you take out 76.90. I wouldn't be surprised if we're at $80 or $85 by Jackson Hole, and gas in the mid threes heading to $4. I think that's what we're in. And remember, oil is 50% of the commodity complex, and that's where a lot of your inflation is going to come. In fact, oil is often used as an inflation hedge. So you've got financial traders participating in the market along with commodity traders, because if you want to hedge a portfolio for inflation, a lot of people go into that oil trade on the long side because they figure that oil is going to be the most responsive to inflation fears. So I think from both a bullish and technical backdrop kind of thing, that oil is going to drive higher. And that's what I want to be watching for coming out of the Fed. Not a lot happening yesterday. Let's go through the charts. SPY, moving 0.18%. Just use this 424.25 level as a pivot. And remember, you've got the channel here. So really, in my mind, stay bullish above 423. If you lose 423, then it's subject to backsliding, and you see the gaps down below that still need to be filled. Here's the zoom in on that. You've got a ledge here at 424.25. You've got the channel support, and then you've got this base at 423. And I think on any pullback that is contained with 423, you can buy it there with a stop just below. But then if you lose it, you've got to flip negative, flip bearish for a move down to 421.50. And if the market decides they didn't like what Powell had to say, that 423 is going to be a big level, as is 421.50. And then we're into big gaps below that need to be filled and repaired at some point. The Qs. We had this power move out, and yesterday they faded it pretty much the whole day. I don't know if you noticed, but the rate on the 10-year was rising. And so now we're back to 342. I think that's your pivot. Below 342, I think you can come back into this 339.50 area. We can see it here, kind of teetering here at 342. You get much below that, then you got 339.50, and then below that you've got 338, and then 336 as downside targets. IWM came down yesterday, sliced right through this gap, filled it right to 229, and then there was a bounce. So after this morning, I'm going to take out this gap. And I think, just to keep it simple on IWM, I think you can stay long against 229. This is a big level here. Why? Prior low held and resistance here. And resistance here. That makes this an important level at 229. So if that were to break, then you'd be back into this larger trading range down here. And I think you could see some accelerated downside activity down here to 227.25, possibly all the way down to 225. So those are your levels. I think they're pretty clear. But I wouldn't get too bearish until 229 were to fail. And here it is on the 30-minute chart. You can see the gap fill here, a little bit of an undercut, maybe take out a few stops, and then ramp it up the rest of the day and into the close. So just stating again, I think 229 is a great intermediate type pivot. Facebook back at the highs. We talked about yesterday, got this bearish divergence in place. Bulls got to clear 338 and hold it to make the technical picture like really strong. Why? Because then you'd be breaking out to blue sky territory with no natural sellers, but you get pinned down here and not being able to break out. Then what would have been a positive here becomes a negative, because it looks like a double top, with a top being here, a top being here with negative divergence. That could mean a pullback into 334 and even down to 330. And if you were to lose 330, then you're back in way down here. So really important spot right here for Facebook. Apple remains strong. I view yesterday's action as a consolidation type move. And as we discussed, I think anything above 128 is bullish. Why? Because that's where all the converging EMAs are on the daily. Plus, we've got this support and resistance line at 128. So if we were to break out, come back in for a back test, that's very routine and shouldn't concern anybody. The only time you got to get concerned on Apple right now is a break below 128, and then that turns all this into a fake move. Tesla, bad day at the office yesterday, down 3%. Brings us right back to that 595 key pivot level. I think you can stay long above. I think you can be short below, looking for a move down to the bottom of the box. But bulls got to hold the line right here at 595. Microsoft, nice uptrend. Junk day yesterday, coming back into this 258 area. I think the trend is unmistakably higher. And if you were to get a back test of 256, the bottom of the gap, I think you can still buy that. But with the FOMC and then the quad witching, I think you'd have to see some kind of move, because if you buy a weekly option at this point with Powell and quad witching, those premiums are going to be elevated. And even if you're right, even if price goes up a couple bucks, you're probably going to lose on that trade. So yesterday I exited the trade. I didn't catch it right at the high, but once it became clear that it was going to be a soggy day, I took it off. I think I got, 50, 60% out of it. I mean, it was a good trade, not the trade that I wanted. I wanted, obviously, a follow-through to fill the gap, but I didn't get it, and then pulling back, so I exited that. Amazon, strong move. We've talked about it before. Breakout of 3250 was really important. Breakout above 3300 was really important to take out these resistance points. And now we've got all the moving averages on the daily chart below price. We came up and filled this gap. In my mind, looking at the bigger picture, even though I've got this marked here at the bottom of the gap, I think anything above 3350 is bullish. If you lose 3350, then there's a big chance of a back test back to this 3300 level. So it all depends on time frame, but I wouldn't want to see 3350 fail. And on the upside, you take out 3400, then you're running again. So that's what I see on Amazon. Google is still strong. Made a move down to the bottom of the channel. This is where you're supposed to buy. You've got lateral support and you've got uptrend support. This should hold here. If it doesn't, I wouldn't want price to go below 2420. Otherwise, you're coming back to 2400. And then if you lose 2400, you're back in the soup again between 2360 and 2400. So I think these levels are good. It's all going to depend on how the market reacts to Powell, whether this breaks or holds going forward. And then Netflix lost to 500 yesterday. That would have been disappointing if you were, gunning for the top of this consolidation box after this impulsive move. More or less just gave it all back, making this breakout here look fake. But what would be bullish here is, again, taking out 492.50 and then back up above 500. That would be a very bullish move. And then wrapping up with semiconductors, got the breakout at 252, and then pulled back for a back test. And just like every other back test, this is normal. What would not be normal is to fall back below 252, back into this range. If that happens, your target's going to be 248.50 for starters. And then if it loses that level, you may be coming all the way back here into 244. So a breakout and a back test is fine. A breakout and a back test that fails isn't so hot. So use that 252 as your pivot. So got a little philosophy on the FOMC today. We got some different scenarios for either falling or rising bond yields and TLT with the dollar in there. Those are going to be our barometers and our gas and our brake pedals for the different sectors that are out there that would be most levered to those moves. And then we've got to hold the wheel firmly. And when we get the input, and once we've made the decision that they're fading rates or they're ramping rates, we'll turn the wheel to that scenario and be in the right sectors. Because I think whatever move the market makes at this juncture is what we're going to have at least until Jackson Hole. And that's 2 months away. So that's going to be a lot of time for the market to work in our favor if those trends persist. So let's watch it carefully today. Don't get yourself in trouble trying to trade Jay Powell. That's unpredictable, and the algos are going to be a lot faster than you are. So trade small, if at all, and let's see what happens. I hope you found the information helpful. If so, and you're new here, I appreciate you visiting. Hit the subscribe button and the alarm bell. You won't miss content in the future. And of course, visit our blog site. There's a link for it in the show notes. And longtime supporters, I really appreciate you being here. Hit the thumbs up and pass the link along and help me grow my channel. I'd really appreciate it. It's been Chris Butts with Traders Profit Compass. Talk to you next time.